You have this problem in your trading right now. The market is doing phenomenal. It's hitting fresh all-time highs. You have positions, but they haven't started to move yet, and you're seeing other setups, and those other setups look great too. The ones that you're holding haven't done anything wrong, but they haven't gone quite as far as you thought that they would. So the question is, what do you do with the ones that you're holding? Do you chuck them so that way you can make room for the other ones? Do you go on margin? How do you handle the situation? So I want to give you two main ways that I personally handle this question. My name is Mike. I am the founder of MarrowWealth.com. I have been trading now for over 20 years, and I have made the transition successfully from trading part-time, having the day job, doing it part-time, and then making the transition into being a full-time trader, full-time trading coach. And I want to help you. If you're feeling trapped in a trade, this is the reason. You don't have enough fire exits for your trades. Think of it like this. You walk into a movie theater, right? You walk through the door and your first exit is the one behind you. That's your stop loss, right? If we're putting this back to a trade, that's a stop loss. And then let's say somebody screams out, fire, right? The first place that you're going to run is right behind you, right off the door. But let's say that you got there late, the seats are kind of crappy, and you're like right on top of the theater, right on top of the screen. Then, if you only have one other spot to run to, then there's going to be the exit right at the front of the theater. Great, so there's two exits. That's what you have right here. You just have the stop loss where you got in, right, like to run back out the door, or you have your profit target, which is right at the front of the theater. That's not enough for your trade, right? You want to be able to get out if the movie sucks. At this point, you're just kind of locked in to the theater. So what I want to give you are two additional ways that you can exit this trade if it ends up not being the great movie that you thought that it was going to be. Here's your two additional fire exits. You have your trailing stops and you have your back stops. Let's talk about trailing stops. Let's say for some reason you decided to buy right there. You thought that that was a great entry. All right, fine. Now the trade is moving up. It's moving up. It's kind of just moving around sideways at this point, right? It hasn't done anything wrong, but you didn't buy this thinking that, oh, it's just gonna move around sideways. You expected it to go way up here, right? So this is where the trailing stop comes in, because if you don't have some kind of a trailing stop, it could just move sideways for several weeks, several months, well, whatever it is, and that's opportunity cost, right? You could be in that other trade that you saw, but you're busy sitting in this one that's not going anywhere. This is why you want to have the trailing stop. And this is where a moving average can come in real handy. So right here, we have our moving average. And so each one of these prices, right? So we have the price bar, and each one of those little sideways moves, that's where price is closing. So let's say that you set up a rule that if it closes below whatever this moving average happens to be, that you're out, right? So in this case, it's starting to get support around this moving average, but right over here, you're out of the trade. Why? Because it closed below that moving average. And the next day, what happens inevitably, right? Like this always happens. You get that big move right back above the moving average, and then you're like, God damn it, I should have stayed with that trade. But you don't know what's going to happen the next day, and the next day, and the next day, and the next day, and the next day, or whatever periods these happen to be. That's why it's so important that you have some kind of rule that's going to take you out of the trade. You only want to be in the strongest trades, the ones that are showing the best momentum, and you should actually be happy that you get to exit right there. The reason why is because the market is incredibly abundant. The market is an endless stream of opportunity. With that in mind, why would you want to sit in a trade that's just going nowhere, right? You saw those other opportunities. You want to be able to get into those opportunities, but you want to be able to do them at the right time. So you need to have a rule that says, you know what, this trade just isn't going anywhere, or it's not moving as fast as I thought that it would, so I'm going to exit this trade. Now, earlier you saw that it was not just profit target, it was profit targets. It wasn't just stop loss, it was stop losses. It wasn't just trailing stop, it was trailing stops. So you could exit half of your trade if it closes below that moving average. You could exit a quarter of your trade if it closes below that moving average. You don't need to make all or none decisions. That's the beauty of the market. You can, maybe you draw another moving average, right? Maybe you use a slightly slower moving average that if it closes below that one, then you'll exit below that trade. And you know what? The way that I drew it, it closed just above that moving average, right? So maybe you're still in that trade, but if the moving average came up here, then you're out of the rest of it, right? You can have whatever rules are going to be best for you. You could have whatever rules are going to serve you best. Whatever your personal style is, that's what you want. For me, I want to be out of a trade that's not moving in my favor because it goes back to that initial belief, right? The market is an endless stream of opportunity, and so I only want to be in the ones that are treating me well. I only want to be in the trades that are going like this, right? Where we could trail up a moving average this way, and if it does start to come back down, right, then exit a portion right there, versus just sitting in this one that's only moving sideways. So we've introduced trailing stops, which are great. They'll help get you out of those long sideways trades. But sometimes you have a trailing stop that would act like this, right? Where price is moving up, it's in your favor, it just keeps on moving up, but it doesn't stop you out of the trade early enough because over here, it touches the moving average, but it doesn't quite get you out of it. It ends up getting you out of it way down here if you're using a close below that moving average. So we want to have some other mechanism that'll help get you out of the trade too. What I like to do it is call it backstops. A backstop kind of looks like this, where price moves up, it consolidates, and then it breaks out again. Then it moves up, it consolidates, and it breaks out again. And so what you end up doing is you figure out where the new floor is. Where did price come down to, test, and rally from? That becomes the new floor. You could also do this with resistance becoming a new potential level of support. So if you're looking at this, like this is the ceiling, you could look at that as a potential new floor, potential place where you would set your backstop. Either one works. In this example, I'm saying that once we break out of here, price should not come back and fall below that line, right? So price broke out over there, it should not fall back below this over here. Price broke out there, now it closed below that line. That's taking you out of at least part of the position, right? So now we have 4 different ways to exit trades. We've got profit targets, we've got our original stop loss, we've got the trailing stop, and now we've got these backstops. So what I like to do is to exit my trades in quarters. So I would put 25% if we hit a profit target and set multiple profit targets along the way. I would exit 25% of the trade if we fall below the moving average, and then have different moving averages along the way to help get us out. Then have different backstops set up along the way and say, you know what, I'll exit a quarter of the position if we close below the backstop, but another quarter of the position if we close below the moving average. Great. So at this point, maybe you're out 50% of the position, maybe you're out 100% of the position because, hey, this up here, maybe that was your profit target. So the main idea is that you want to have multiple ways to exit your trades, and think of all these stops, all these exits as the way that the market is ultimately going to pay you, right? Most of the time, traders will get into a position, it starts working in their favor, and then they fall in love with the position and they want to stay with whatever this trade was. But guess what? You're not meant to marry the trade. You are meant to get into the trade, and you're meant to be with the trade for as long as it's going to be paying you. And then when it stops paying you, when it does this, then you want to be the hell out of there. So it's paying you, it's paying you. You have multiple ways to get paid from this trade now. You're getting paid based off your profit targets. You're getting paid based off of this moving average. You're getting paid based off of if it breaks below your backstop. Great. All these different ways for you to get paid from this trade. And the one way that you're going to get stopped out where you're going to end up losing money is way back here if it falls back below your stop loss. That's actually the one time where you might exit the entire trade all at once, or you could even have a bracketed stop loss, but we'll save that concept for another video. Want more content like this? Drop a comment down below. Let me know what you want to see next. Also, if you like this video, take it, share it with somebody, hit the like button, and subscribe to the channel. There's going to be a lot more of this kind of stuff coming your way real soon. Take care, everybody. Peace out.